All right, welcome to Return on Life. This evening, I have with me Adam Rose. Adam is the one of the co-founders and is the CEO of Align Mortgage Corp. Adam, welcome today.
Thank you very much.
Yeah, so maybe before we get into kind of the main subject, just maybe if you can share with the audience a little bit about yourself and what got you to where you are today.
I spent 20 years, maybe more, as a portfolio manager at one of the big investment dealers. And then, about 20 years ago, I started my own investment dealer. And one of the things when you're a small investment dealer is there's no brand presence and you have very little in the way of marketing budget as compared to your big competitors that are owned by the banks. So what a small dealer does is create good products and good services. And there was a demand for private debt or private mortgages. And so I created a pool which ended up being one of the largest in Canada through my experiences there. Our clients really liked it. It was a good way to smooth out their returns and give them a boost in yield, in addition to what they were already doing in the equity markets or looking for dividend yield, etc. And then we've started another fund under a different name, Align, and that is primarily where the first one was focused on construction. This is primarily focused on it's a little bit of commercial, but mostly first and a few seconds in residential, and we like that because it's a very safe space.
Yeah, so you mentioned, maybe people are familiar with the term when you say private debt. What does that actually mean?
I think the best way to describe it is that it's not something that goes through the banks or other big financial institutions. It can be two things in a very basic way. It can be direct investing into mortgages. So, Peter, you have a house you want to buy, and you approach me and you say, Adam, would you lend me X number of dollars so I can buy the house? And I'll say, yes, of course, after doing some due diligence. And that's one way of doing private debt. The other way of doing private debt is a pool where we got a bunch of Peters all wanting to buy houses, and we have a bunch of investors who invest in the pool. And then the pool subsequently loans the money to the pool of investors, the pool of borrowers.
Okay, and so if I am looking at this, so I mean, who would those clients be? Maybe not the investor side, but the people who are taking down the mortgages. Like, where are people, and how big is that market potentially in terms of the need
Well, the
for?
market is huge. It's north of $40 billion just in Southern Ontario. That's according to the CMHC, Canada Mortgage and Housing Corporation. Now, those borrowers are actually quite good in terms of credit risk. They have good income, good credit scores, but they don't check all the boxes that the banks want. Case in point, a new immigrant comes here as a doctor, but doesn't have any credit history in this country. You know he's going to make a great living as a doctor, but for the first year or so, the bank is going to say, no, come back. Or a small businessman, the self-employed people, he may be making $1 million a year, but he may not be showing all of that on his T1 because of, he might take it out as dividends or shareholder loan or whatever the case may be, depending on his tax planning strategy. And the bank says, well, I don't know, we can't verify it to our satisfaction. In other words, they don't tick all the boxes, even though these are very good borrowers. And the banks have willingly ceded the space to private debt.
So that's I think that's an important piece to see, because I think there's I mean, how many small business owners, how many people are out there that are in that same situation? Obviously, you said the market is just in Southern Ontario alone at least $40 billion, right?
Yeah, and that may be accurate. That's an estimate by a government institution. It may be higher. People who just maybe have not even gone into the market, or they've gone to family members. So it might even be a larger market than that is. Sorry, excuse me, than that's reported.
In the I guess if I were looking at this as a take by, well, let's talk through this part, I guess, a little bit more through that side of things. So bank won't take it, but folks like yourself on a line will take on that risk. Are there extra steps that you're doing to take on that? I know from a standpoint of looking at an investor, I'm like, okay, the security is the property, right? Or the
Correct. So is there any additional due diligence we take?
yeah.
I would say that our due diligence is at least the same as a bank, and maybe even a little more detailed. It's also a little more creative because, for example, we'll pick on you again, Peter. You want to buy a house with your wife, but you also own an income property that has no mortgage on it. Well, we may say to you, Peter, just for safety's sake, let's have both pieces of property as our collateral.
Hmm.
Can I go back to one point that you made, which
Yeah.
was really
Yeah.
interesting? It was about small businesses. 70% of all employment in this country is small business,
Hmm.
fewer than 500 employees. And not as commonly supposed that it's big corporations. And so there are an awful lot of small business owners out there. It's a huge market. And that's why I'm sort of saying, well, maybe 40 billion is even too small an estimate.
Yeah, no, absolutely. Absolutely. I mean, I think that's, one thing too. I think maybe you don't know that it's out there until you are until you become self-employed or start running your own business, that
Yeah.
there's that opportunity, right?
I speak to small businessmen a lot because a lot of them are investors too. It'll bring up another point that's important on the investment side, but I'll address that in a few minutes. And the frustration I hear in getting debt for themselves, home equity lines of credit, which is not something we do, but it is problematical for small businessmen. And it's hard for them to get mortgages if they want to buy a new home for their family.
Right.
I hear it a lot.
Yes, you're providing an opportunity for them that otherwise just wouldn't be.
Yeah, well, we're providing a chance to improve their lives. I'll give you an example. My daughter is very altruistic, one of my daughters, and she says, I want to be in financial services. And now she's not coming in with me because I don't really believe in nepotism, but she said, because I think it's a useful way of helping people. They can build better lives, help them get houses, help them, on the investment side, build better retirements. So that's kind of what we do in private debt. We improve the conditions of people's lives, both on the borrower side and the investor side.
And I guess if I go just talking maybe small scale, there's the mortgage broker side. They're providing some type of service. Are they coming to folks like you in order to be able to fulfill that?
They are.
Need?
They are. We have an extensive network of mortgage brokers that bring us deals. We have an extensive network of people who simply refer, Aunt Sam or Uncle Aunt Sam, that didn't sound right. Aunt whomever, aunts and uncles, mothers and fathers, that also will come to us through referrals.
And that brings us to maybe we'll switch hats to the investor side. So maybe talk about the opportunity on the other side. So you are providing opportunity for people to obviously, from getting a home or a piece of property, but then on the investor side, what's the opportunity there?
Well, I want to break that down into two different types of opportunity. And before that, I want to say what, in a global sense, what the opportunity is. I hear an awful lot of people getting into their 50s and 60s, and some in their early 70s, saying, they're a little tired of market volatility. Now, I know the market's been on a tear lately, but in any 10-year period, private debt will typically eclipse the returns of the stock market. And I say this as someone who's got a substantial stock portfolio, but my private debt holdings, which make up part of my portfolio, typically eclipse it in any 10-year period. So that's an important benefit to what we offer. I think I'm 61 years old and I'm not going to retire anytime soon, but one of the things I think about with my father in a retirement home is, you have to plan for that. And using private debt is important because it helps you build enough capital so that you can have a dignified retirement. And it helps provide you with enough income that you can be in a good facility. I think that's an important point. So the opportunity, sorry, I didn't mean to distract, but I think that's an important reason to do it, among
Right.
other reasons.
Right.
Diversification and is, so let's just use an example here. I was talking with a dear friend of mine yesterday. She's 63 years old. And because of the recent inflation, she's running out of money. Her financial advisor told her that unless she can up the yield, because she's now eating the capital, with blueberries at $6-7 a package, that she's going to run out of money at age 73, and she's very frightened. I think one of the roles that private debt can play is, take away some of that fear. We can help grow the capital until you need to draw on the income by reinvesting the dividends, and then you'll get a better return. Now, I'm not saying it's going to solve everyone's problem, but it's certainly something that people should think about to have a decent retirement. So, two ways to do it. You can go directly into mortgages. The good news is it pays quite a good income. You could get 8-9%, could get more, but be wary. If someone offers you 14%, be aware that it may be an honest and well thought out investment, but it probably carries a pretty high risk, and you should be aware of those risks before you invest. And good luck to you if you do, and maybe that's appropriate for you. So it's appropriateness that of risk that comes with the return you're getting, and so that's good. The challenge with it, depending on what your objectives are, is that you can't reinvest the dividends. You just take the payment every month. So if you want to grow your capital, that's not a way to do it.
Or you just have to be very diligent with that money and make sure that you don't spend it, because that's maybe part of the problem.
Well, that's a good point. Some people spend it. The other thing is that if you invest directly in a mortgage and it comes due, you may not find a mortgage that's suitable to your objectives and risk tolerance for another 3 or 4 months. So if you look at your yield I always think in terms of the portfolio. If you look at the yield of your portfolio, it will decline because you've got the money in the bank as opposed to being deployed into a revenue producing mortgage. The other thing is you're exposed to one borrower. If that borrower runs into trouble, then you're exposed to that. I'm not suggesting you'll necessarily lose money, but now you've got to take appropriate legal action, and which can be expensive. Now, look, at the end of the day, the borrower pays for that, but you may have to front the cost. The other way to do it is through a pool. Now, I personally go through a pool. If you were to ask me, what do you invest in? Do you go directly or a pool? I think either is a valid choice, but for me, the pool suits my investing style a little better and my objectives a little better. So with the pool, my money's always deployed because there's a whole suite of mortgages that are always rolling over, and so my money's never sitting there in cash. Maybe for a day or two, but not most probably not even that. Secondly, I can reinvest my dividends, which means I'm growing my capital. In our particular case, we reinvest every single month. So that gives me a higher yield than if I were just taking the cash and hopefully not spending it. Now, personally, I'm not going to spend it, but I know other people will spend it because it's available. And the third part, which I like best for myself, and I can only speak for myself because everyone's got different objectives and risk tolerances, is I like to spread it out over a number of mortgages, like over a whole pool. So if one goes into default, the probability of me having a diminishment of my income that's significant is very small, and the probability of me losing any capital is very small. And that suits me. And by and large, if you go directly into a mortgage or you go through a pool, you'll get about the same return, maybe a few basis points different, but it's generally the same. If you're comparing apples and apples, I mean, if I were to go into a pool that invested in, just second mortgages, for example, I would get a higher yield, but I would take a bigger risk.
Right. Right. And so, if I look at this, so, going to, more the aggregated or is it called, like, it's called the mortgage trust? What's the proper terminology for
the vehicle? Is a trust. In our case, there's also a mortgage investment corporation, sometimes known as a MIC.
Right.
From the purposes of the investor, it really doesn't matter. Both are ultimately RSP eligible if they want. It's just a structure that the manager chooses, but
Right.
for practical purposes, it doesn't really mean anything.
Yeah. So one versus many, gives you de-risk your yield. So
Yeah.
it's going to be flatter in general. You're not chasing deals. You're not chasing potentially risk, the due diligence, the underwriting. To an extent, if you're doing a mortgage yourself, you want to be involved to a certain amount. Or
Right. And by the way, for some people, that's perfectly appropriate and
right,
even desirable.
it's a sense of control.
Mhm.
So getting, and then the other pieces too is obviously putting it into a pool fund. You're able to redeploy those
Yeah.
earnings back and continue to compound what you've built.
So I'd like to remake my point here.
Yeah.
If I go directly into mortgages and I get a 9% yield, just to pick a number out of the air,
Mhm.
or I go into a pool and get a 9% yield, it's more probable that I'll maintain 9% yield in a pool because I won't be waiting around once the mortgage returns. Because during that cash, I'm getting zero. During that time where I'm between mortgages, I'm getting zero yield.
Right.
So maybe my yield at the end of the year, just for example, is 7% instead of 9 because the capital wasn't deployed for 6 to 8 weeks.
Right. Yeah. You're risking your annualized return.
Yeah, that's exactly right.
And okay, so as an investor, a maker trust, it shouldn't really make a big difference to them. And
Not really.
what are good things maybe for someone to look out for in a, you know, one of these types of investments? What would
I
you say?
think you're sent documentation. Let's just use the pool as an example for the moment. You're sent documentation. Read the documentation. Know who's involved with managing it. Because what matters more than anything is the management team. Don't chase rates.
Mm,
Don't, because someone's offering 14%, they may be completely honest and competent operators. So you'll have no problem there, but they are taking more risk with your money to get that yield. So watch for that. Be aware what the risk you're taking is. And we've heard some stuff lately about people got 18%, but now their capitals is highly at risk. You may even be compromised because they chased rate and they didn't understand the risk associated with it. Look, I have a friend who chases rate, and now he owns a mushroom farm because he had to foreclose, and because he chased 16%.
right.
I don't think he understood that he would end up operating a mushroom farm.
Right. Fair enough.
Maybe it's a good business, but it's not the business he wants to be in.
Yeah, that leads you to the next question. I think you've alluded to it in a couple of things that you've mentioned there. So I want to talk about outcome. So
Yeah.
how do you, ways of getting out of it? One is you're literally could get stuck with the property, in one of these situations. But how, as an investor, if it is through, one of these funds, you've done all the research, what's the end game for it? How are people moving their money out of it? How long do they typically have to keep it in there?
All right.
You
So,
want to have liquidity.
well, if you're in a direct mortgage, like I've lent you some money for you and your wife to buy a house.
Right.
I'm in it for the duration of the mortgage. There's no liquidity. I can't suddenly say, hey, I've got something else to do with the money, Peter, give it back. And you're going to say, well, that's not what the mortgage agreement says. If you're in a pool, and I'm speaking, about us and our worthy competitors, it's a typically 30-day period to get your money back because it's usually done at the beginning or the end of the month. Now, there are limits to that liquidity. The reason that the yields are typically very good on a pool is because the job of the manager is to keep as much of the money deployed as much of the time as possible. So what I say to people is if you're building let's say a bond ladder using private debt, meaning different maturities, think of any private debt in a pool as having a 3 to 5 year timeline, which is not to say you're locked up. You're not. You can get out any time, typically on 30 days. But if you're building your portfolio, you should think of it as a medium-term investment. Don't look at it as a treasury bill. It's not. And you'll be very disappointed if you put in your investment with the idea that you're going to get it out the next day. Because meaning we as an industry, we've already deployed your money into mortgages. That's why you're getting the return you're getting. So be mindful of what your objective is in terms of time. Like if you're going to, make a wedding for your kids next year and you want this money, don't invest in a private mortgage, like a private mortgage pool.
So you're saying, thinking when you say midterm, are you saying like 5-10 years, or what is that?
No, I think 3 to 5 is an appropriate timeline.
Okay.
So in other words, I'll give you an extreme example. If in 5 years you're going to move to a sunnier place and a warmer place, and you're going to need to buy a property down, let's say in Florida, for the sake of the argument, and you put money into a private debt fund, you should start asking for that money a bit ahead of time. Like, don't do it the day before closing, saying, "Oh, I need the money," because what if that money just got deployed? Then you've got a problem, and you've set it up yourself. But if you say, you know what, I'm going to buy it in 5 years, maybe a year before I'm actually going to buy it, I'm going to start taking money out of the pool, then that's the way to approach it. If you have a short-term need for cash, buy treasury bills. They're safe, they're guaranteed by the government, and they're highly liquid. That's the appropriate investment if you have that short-term obligation.
Right. So time frame of someone investing. What about and maybe just talk in general, don't talk specifically to Lime, but what is a typical time horizon of say a mortgage trust or a MIC? How long are they typically?
The duration?
Yeah. Is it?
Oh, they're indefinite.
Is it indefinite?
They're indefinite. Yeah, they have unlimited life.
Do they have funds that might, they might max out a fund and then open another one? Is that?
They might, but typically, unless the next fund had a different objective, you wouldn't. Cost of starting a fund is expensive, and you wouldn't start another one unless it had a very different objective, very different lending criteria. But the fact that it has a long life, and I have a 29. One of my daughters is 29, and she's an investor, and she's on dividend reinvest. Like, she might have 35, 40 years until she decides she needs that money or wants to use that money. So the fact that it has essentially an unlimited life is to her benefit.
Right.
Especially if it's in a registered plan.
And does that get, to pull these funds out, obviously have to pay your taxes eventually, right? At some point, if you're pulling it out of
an RSP?
Yeah.
Yeah, but that has nothing to do with what you invest in. You could invest in bank stocks. You still have that. Like, I just had a look at my dad's RIF. My dad's just about 90.
Yeah.
And there's a prescribed amount. In fact, I got the paper right in front of me on my desk here.
Is it regulated by is it?
Oh, yeah. You have to take out a prescribed amount every year, starting at age 71. As my dad's 90, he's been pulling out for 19 years.
But the mortgage trust, let's say, would they regulate how much they would hold back?
No, just the RSP. The trust, they don't care. If you have a trust and you've got stock and bonds and whatever you might have, different mutual funds, it's at your discretion what you cash in to take out. But the government mandates that you take it out until the RSP is completely, it becomes a RIF.
Right.
And then a registered retirement income fund. And at some point it has to be entirely depleted, but I've forgotten that age offhand.
Can these investments be transferred to a spouse, to a corp, to another generation? How is that?
Well, it's a bit of a gray area. So if I were to sell my units to you, you would have to be an accredited investor as well. You have to qualify. But my daughters are not accredited investors. I could gift them.
Right. Within family.
But if I, for example, wanted to sell them to a corporation, the principals of the corporation would have to be accredited as well.
Right.
and we'd have to file that with this appropriate regulator. Now, I shouldn't use the word accredited because there's different categories. There's eligible, there's accredited, and there's permitted. So let's say qualified investor. That's a better term for that.
Right. Okay. We kind of talked in generalities here, and I think without saying it's for educational purposes, not a recommendation. I think you've said this before, right? So people,
Yeah,
give them some information that hopefully will enable them to make more informed decisions down the road. Maybe talk a little bit about Align, what makes you unique, and just maybe expand a little bit about that.
I think what to use a business term, what our unique value proposition is our strict underwriting criteria. Rule one is don't lose any money. And so our underwriting criteria are very strict. As I said, they're like the banks, and in some cases they might be a little harder, but we understand the nature of the borrower, and we have different boxes to check. So I think that's really important. The other thing is don't lend too much money against any individual property. So our average loan to value right now is 62%, which means that's on the portfolio. So that means for anyone to lose $1, it would have to drop 38%.
Right.
So that's one thing. Sorry, and what was the other part of your question?
Oh, it was just to talk some of the unique things that.
Yeah. So the other thing that's important is that we communicate on a very timely basis. Like you're never wondering what's happening with your investment. I think the other thing is that we can give a borrower typically 48 hours, providing all the paperwork's present, a decision. Now that's a lot faster than a bank can do it. And I think our unique value proposition is our, we've got a good yield and we have fairly low risk. On a risk adjusted basis, we have a very good return. Our rolling 12-month yield is 9.83%. Now it's not going to stay there forever. That's a function of the Bank of Canada rate, but we do target 8%. Now there's a lot of our competitors that target 8% as well, and they deliver it or more. So the thing that we bring to the table is we do that with a very low, risk, which is not to say we're risk free.
Right.
Once again, I say if you need risk free, buy down your bond, but it's quite low for the return. Like you're not.
And you are where most of the investments are the more
Southern Ontario.
Okay.
Now there's a really important point that I want to make. You know what your house is worth?
I think so.
All right. Well, let's say you do, and you probably know what your neighbor's house is worth, more or less, and you know what the guy down the block is. But you and I live about 10 kilometers apart. What's my house worth?
I don't know.
Probably don't know. So we only lend into markets that we know really well. It's a really important point. I certainly don't know what someone's house in Victoria, BC is worth.
Right.
Beyond what I might read in the papers, but that's not sufficient enough to do an underwriting.
But that process involves you're gonna get like house appraisals and.
Oh yeah. We get independent house appraisals. We go out and do site visits. We make sure the property is what is advertised to us. I mean, advertised is just a colloquial term for that, but it's got to be what the description says it is.
Right.
We're quite careful about that. We're careful about checking income. We're careful about most of the collateral. There's an interesting thing here, if I can bring this up, is that I like to talk about risk a bit. So if you're lending someone money to buy a house, it's because they're typically moving their family in. And one of the reasons why house mortgage debt is so safe is because you will stop paying your car, your credit card, before you ever stop paying for your house, because you do not want to get your family thrown out on the street. So I'm not saying it doesn't happen. Well, thankfully, we've never had to do it. But it is a truism of life. You're going to do everything you can to keep your family protected. And that's part of it. And that's one of the reasons why investing in private debt for houses is such a safe way to go.
Right.
I don't know if I answered your question as well.
Yeah,
as I
I think we did. We had a good. I think we covered a lot today, and yeah, I wanted to just thank you for sharing, imparting your knowledge, and sharing a little bit about your journey as well.
Well, I hope what I've said has been of value to the people who are listening to this.
Yeah, people want to know more about what you do and want to connect with the line. What's the best way to?
They can call me directly.
Okay.
And if they choose to make an investment, we have a third party that's licensed to offer the securities to them. But as CEO, I'm entitled to speak with anyone who might want more information about the company.
All right. So I think
I guess you would provide that if I don't know.
Yeah, we definitely can provide it. I think I mean, this is also live on LinkedIn as well. So I've tagged you on that too, so people can do a direct connect there too. Yeah, if anybody wants to reach out to me to connect with Adam directly, then I'm happy to do that too. You guys, the website is, let me just pull it up here.
alignmortgage.ca.
alignmortgage.ca.
Now, that being said, we're just in the process of doing a revamp.
Oh, okay.
It wasn't. We want to make it a more user-friendly experience. I guess these things are always being improved.
For sure. And I see you have you guys are doing webinars as well too. And
we are, yeah. And we do live presentations as well. We've got a couple coming up in April in Toronto, dates to be determined.
Okay. Well, yeah, shoot those out, and I'm happy to share that with the community as well. I think that's always a great way to kind of, meet people in person, get an idea, cure this up.
I think that if you come out, and even if you learn something and don't invest with us, but it improves your situation, helps you sleep better at night, then it was worth coming out.
For sure. Yeah, that's great. Well, Adam, I appreciate you sharing your knowledge, and look forward to maybe we can do something like this again.
I really appreciate you having me and by extension our whole team here. We're 37 people, and I guess I'm representing them for tonight. So thank you very much on behalf of all of us.
All right, my pleasure. Okay.
Thanks.
Thank you.
Good night.
Good night.